This artificial intelligence infrastructure boom is carrying the broad macroeconomy a lot more than the historic dot-com boom ever did. Back during the 2000 tech bubble, you simply did not get this specific kind of massive physical investment pumped directly into the structural economy. Right now, in late 2026, you are getting massive capital expenditure spread across the entire country in the physical building of high-end data centers, thousands of real people being employed, utility power companies seeing historic grid demand, and literal millions of gallons of cooling water being demanded every single day. There is collectively a hell of a lot more real accounting going on here if there is a major stock market correction than there ever was in the dot-com boom. In other words, when the music finally stops this time around, it will be worse. It will be significantly more market-wide across your entire portfolio. It absolutely won't be just a simple isolated tech company stock correction. It will be a brutal valuation correction across way more economic sectors than you saw back then and more of a severe macroeconomic hangover that will take a little longer for retail investors to get through. Let us look at today's random number 1 million. That is exactly how many dollars worth of rare Yu-Gi cards were found stashed inside a random Texas dumpster last week. A real true story. I am personally literally swimming in Pokemon cards at my house right now because my teenage son listened to me and Aswath on our last podcast and is currently spending all of his hard-earned cash on Uber rides, Deliveroo deliveries, and rare Pokemon cards. Not a single joke here, just a hilarious financial observation into my own household life. Ed, how are you doing over there? I am doing well, man. Deliveroo? Wow, that is a vintage company name I forgot completely about. That is essentially the English equivalent of DoorDash. Actually, it is the Australian version of DoorDash. Yeah, Deliveroo. What exactly is he ordering to the house every day? Wagamama Nando's. What are the big hits over there? Oh my gosh, you are surprisingly very in touch with millennial fast food. If it were entirely up to my son, he would eat corporate Five Guys burgers 3 times a day. And unfortunately for my wallet, he is actually pretty good at this whole Pokemon card trading thing. He understands arbitrage trading. He goes to these sketchy weekend card conventions, and to be honest, I am incredibly impressed and proud of his hustle. He will literally take a train all by himself out to Heathrow Airport because there is some massive card conference going on near there. He goes strapped with a ton of rare collectible cards and a few £100 in cold hard cash, trades cards all day, comes home, sells them for a massive premium, and then instantly uploads the profits onto his Greenlight card so he can take private Ubers everywhere and order all manner of junk food from different restaurants. We will get a loud bang at the front door at 11 p.m. I open it up and it is a food delivery guy with a bag, and I am like, oh, this is for him again. He orders his own premium food now, and then I say, that is it. We are absolutely not paying for this luxury lifestyle. And he looks at me dead in the eye and goes, you are not paying for it, Dad. I sold a rare Gawa card this morning for $400. So anyways, his newfound economic independence is getting seriously in the way of my ability to discipline him as a father. That is awesome. Good for him. The kid is basically running his own private card hedge fund at this point. Sounds great. Guess where I am flying out to tomorrow? Where are you going, man? I am going to Poznan, Poland for a major economic conference. It is a big deal. There is a massive economic conference happening out there. What are you going to do out there? Speaking on stage for cold, hard money, obviously, but here is a completely crazy macroeconomic stat for you to chew on. If Poland continues its current annualized GDP growth for the next 4 years, it will officially be a bigger economic powerhouse than the entire United Kingdom. They have been one of the real structural winners from the geopolitical war landscape. I mean, I think their domestic stock market has absolutely ripped over the past couple of years. Poland has just sort of done everything right from a policy perspective. You are exactly right. They have been a massive winner here. It has been a fantastic domestic economy and a massive economic success story. Well, we have a big episode, an incredibly exciting live episode to get into. Today, we are talking face to face with Aswath Damodaran in our very first live stream. But before we get into the deep math, I just want to point out that it is exactly 12 days until the official Prof Markets Tour kicks off across the country. We have a completely sold out show in San Francisco on May 27th, but you can still grab last-minute tickets in LA, Miami, Chicago, and New York City. We will be finishing the entire tour off with the one and only Anthony Scaramucci, the Mooch, who will be joining us live on stage on the 2nd of June. I cannot wait for that night. I mean, the Mooch always delivers an absolute banger of a show, always brings crazy energy, and it is going to be a lot of fun. So if you want to go see those live shows, you can visit profmarketstore.com to get your tickets right now. That is profmarketstore.com. 12 days left. The link is right in the description down below. And with that, let us get straight into our episode. Welcome to our first ever Prof Markets live stream. We have an incredible jam-packed episode for you. Today, we are joined by the man, the myth, the valuation legend, the one and only, the true dean of valuation, our good friend Aswath Damodaran. We are doing another deep quarterly review of the SP 500. And the great thing about this live stream format is that we will be taking your raw questions from the audience, or at least Professor Damodaran will be answering them. So if you want to drop a question right now, ask anything, drop it directly in the live chat, and then we will save some time at the very end of this interview, about 10 minutes, and we will answer a few of those questions live. But with that, let us get straight into the show. It is that exact time of the financial quarter when we like to check in with one of the specific market voices we trust most on Wall Street. Late last year, he warned us directly that there was absolutely no place to hide in stocks. We also met again in February, and he pointed out and told us some of the catastrophic economic risks that the broader market seemed to be at least slightly ignoring. And now with the ongoing military conflict with Iran, with 3 massive tech IPOs approaching, and with artificial intelligence continuing to push megacap stocks to new record highs, it seemed like the absolute perfect time to bring back Professor Aswath Damodaran, the Kirshner Family Chair in Finance Education and Professor of Corporate Finance at the New York University Stern School of Business. Professor Damodaran, thank you so much for joining us again on the channel. We are so incredibly excited to get your raw macro update. Let us just start very broad here for the audience. I look at the SP 500 index today. When we last spoke on a forward P multiple basis, it is actually lower than when we last spoke. However, it is also up almost 8% year to date, which is quite striking really for most investors. When you just look back at the first quarter that we have seen here, what has struck you most about the markets that we are witnessing in 2026? The sheer resilience. I mean, I think that if nothing else, global markets seem to be showing that they can successfully withstand massive geopolitical shocks that they would not have been able to withstand a decade or 2 decades ago. You know, one of the fundamental things about analyzing markets is the very first time you disagree with market pricing. You can easily say markets are wrong, I am right, and be totally okay with it. The second time around, you can keep saying it to yourself, but by the third or the fourth time you say it, you got to stop and ask a hard question: what is it that has fundamentally changed that I am completely missing in these markets? And I have been thinking a lot about that exact concept, because starting in March, when we entered this new crisis with the military conflict in Iran, I actually started estimating what is called an equity risk premium, the true price of risk in the market, like a real-time temperature gauge for Wall Street. And what astonished me in March at the height of the crisis, even with the major indexes going down that month, was how incredibly measured markets were in response to the geopolitical crisis. So I think the key word here is markets seem to take whatever garbage is thrown at them and come out on the other side completely intact. And on one side, people might say, well, this is because markets are blind and don't see what is coming down the pipe. And on the other side, you got to stop and ask, maybe there's something structural that has changed that is allowing markets to do this so easily. When you look at the conflict in Iran, I mean, just when I look at it with my own eyes, my sense is this is tea coming to an end anytime soon, or at least world leaders keep on saying it will. They say it is going to be next week. It is going to be the week after that. We are going to get a massive peace deal. We are not going to get a deal, etc. It just keeps on going and going on endlessly, and continually gas prices are rising up 30% since we launched this project. And it seems that I don't see how this is really going to change anytime soon, and I guess I am sort of waiting for that sudden moment where it does have a massive visible impact, where it severely impacts consumer spending, where it does end up hurting mega cap stocks, but I guess that catastrophic moment just isn't arriving. Do you think that moment will eventually arrive, or are the markets pricing in that? It's simply one. I think at the moment, if all that happens is gas prices stay flat at 450 or 500, per G. Allen, the market, I think, is perfectly okay with that. I think the true catastrophic risk here is not that oil and gas prices stay higher than they were before the conflict started. It is whether they will go even further up from here, because there is always a structural chance of that happening. I think if you look at it, in many ways, what the market seems to be building into valuations is the baseline economy can survive with gas prices being 450 or 500, depending on what part of the country you are living in, and that it might not be as robust as you thought it was 3 months ago, but it is okay. But I think the worry still remains that this crisis, while it is currently in a slow boil, at any given point in time could become a fast boil, at which point you could say what happens to corporate earnings now. And I think that is the part of the economic story that I find most interesting. The earnings forecasts at the start of March, before the conflict officially started for the SP 500, I have been tracking them on a rigorous weekly basis. You know what? Those corporate earnings forecasts now are actually higher for next year and the year after next. They are lower by a tiny bit for this year, but in some strange way, it is almost like Wall Street analysts are projecting that earnings will just get moved to next year and the year after because of this crisis, and that they will actually go up as a direct result of the crisis. Now, you can easily accuse analysts of being way over-optimistic and perhaps heavily skewed in their thinking, but the market has been able to deliver on corporate earnings even in the midst of major crises for the last 10 or 15 years straight. And I think that is exactly what the market is building in. And it is ultimately true that markets are not affected by political crises or economic crises directly. They are affected by what those crises do to corporate earnings. And at the moment, that is exactly what I am keeping my eyes on, is real structural damage being created to earnings. And up till now, we are simply not seeing that damage show up in macro forecasts. Always good to see you, Professor. I have never seen. And maybe there is a historical precedent that I am completely unaware of, but I have never seen a number two company become the number one market leader as quickly as Anthropic has become the number one. Right. In December, it was a clear number one OpenAI. By April, clear number one Anthropic, and in the private venture market, Anthropic is now being valued at a staggering $1 trillion. Would you buy shares at that price? What are your thoughts on the respective multi-billion-dollar valuations of OpenAI and Anthropic? I am incredibly impressed by what Anthropic has done with their technology. Ultimately, with large language models, I have always said the ultimate financial test is how quickly you pivot to having actual business applications that make real money. And Anthropic has been the absolute quickest, I think, to pivot to actually creating something that enterprise people can use right away. Whether you are an investment banker or a corporate lawyer, I think I have been very impressed with what they have delivered. I think $1 trillion is still asking for a whole lot of future premium. It depends entirely on how much these software applications pay off for Anthropic over time. But I think they are, of the different LLMs, they are clearly on the fastest growth trajectory in terms of being able to get applications going and real cash coming into the companies. Let us be real. These tech companies are still massive money-burning machines. I think the question is, when will that cash burn start to decrease? And Anthropic seems to have the absolute best trajectory to start to bring the cash burn down, if not make it cash flow positive. So you published a piece, trillions of dollars and beyond, and put SpaceX intrinsic value at $1,200 billion. So SpaceX, I think it is doing about $16 billion in revenues, growing $8 billion in EBITDA, growing, I think, 24% a year. And then I look at Anthropic, and I understand it probably doesn't have the same physical competitive moats as a SpaceX. But I look at Anthropic, which has jumped to 30, and I think it is headed towards 40 billion in annualized recurring revenue. And it looks as if it might 10 times again. It has been 10-shing every single year. Why would SpaceX be worth $1,200 billion in your analytical mind, and Anthropic be only worth $1 trillion? Help us discern how you value each of those distinct tech sectors. I think it goes right back to what you said first, which is it is all about competitive moats. These companies are all about future growth, future revenues, and future operating margins. And SpaceX has, at least on two of its three core business lines, incredibly clear structural moats. I am not as impressed with the XAI part of SpaceX as some retail people are. For some people, that is the excitement factor, because you can throw trillion-dollar numbers around much more easily. But if you look closely at the space launch business and the satellite internet business, SpaceX has the strongest, much stronger moats than any of the other tech companies, because I can think of very many companies that can compete with them head-to-head in those capital-intensive spaces. So if you believe there's going to be massive growth in those spaces, I think SpaceX is going to have a dominant market share of those spaces. And that is what gives them the clear pathway to the $1,200 billion valuation. But that $1,200 billion requires a lot of macro things to go exactly right. I think if those things go right, then the $1,200 billion valuation plays out perfectly. I think Anthropic has higher revenue growth near term than SpaceX does. I think that is almost a given in software. The real question is how the operating margins in this LLM-based business will play out over time. And I think that Anthropic might be in the best shape of all of the LLM companies, but I think it is going to have to find a way to generate profit margins that are high in steady state. Right now they have the temporary advantage, but will that advantage sustain itself over 10 years is the real question. Taking the macro aperture back a bit, I heard a very interesting comment that you might see if AI becomes the atmosphere, where almost any company in the technology or information sector, which have traditionally traded at the highest valuation multiples, has an existential risk of absolute obsolescence at the hands of AI. Is it possible that we might see just a massive systemic reduction in the value of terminal value? In other words, is there just greater existential risk to all future cash flows amongst the megacap companies that have traditionally traded at the highest multiples? I think it puts every single corporate lifecycle at risk of shrinking dramatically. To me, terminal value is entirely about capturing what happens when a company gets to the end of your specific forecasting period. The 20th century companies stopped in year 5 or 10 and said forever, and then used that standard perpetual growth model, and I have always been a little cautious about applying that to tech companies. And I think what AI does is it takes every single tech company and makes that forever into an even more difficult assumption to sustain, which effectively reduces terminal value, because it means that instead of using forever, you are using an extra